We've just passed the 31st January self-assessment deadline. Your tax return has been filed. The tax has either been paid or it hasn't. And we are now in that short but powerful window before 5th of April, which is the end of the current tax year. This is one of the most important moments in your financial calendar because what you do now determines whether next January feels calm or stressful. Today I want to cover 3 things. 1, what to do if you couldn't pay your tax. 2, why this is the best time to plan ahead. And 3, I'll give you a real life example of how small changes can remove January stress completely. Hi, I'm Lena Odo, Chartered Accountant and founder of G-Hawk Accounting. We help small business owners build profitable, tax-efficient businesses through clear numbers, strong cash flow management, and proactive planning. Let's start with the first one. If you couldn't pay your tax. If you did not have the funds available by 31st of January, do not ignore it. The right step is to contact HMRC and arrange a time to pay agreement. This allows you to spread the balance into manageable monthly installments. HMRC would rather receive structured payments than pursue enforcement action. But here is the important distinction. A time to pay arrangement solves the immediate pressure. It does not solve the planning gap that created it. If your tax bill felt like a shock, that tells us something in your system needs strengthening. Let me give you an example. Last year, I worked with a limited company director. Let's call him James. James had a strong year. His company generated over £120,000 in profit. He paid himself dividends regularly. Cash in the company looked healthy, but he never calculated his personal dividend tax during the year. When his self-assessment tax return was finalized, his bill was just over £28,000, including payments on account. He did not have the £28,000 sitting in his personal account, so he had 2 options. 1, extract more dividends, increasing his future tax liability, or call HMRC and set up a time to pay arrangement. He went down the time to pay arrangement route and we arranged it. But more importantly, we changed his system going forward. Here is what we implemented. Quarterly personal tax forecasts, a fixed percentage of dividends transferred immediately into his separate tax savings account, a reviewed salary and dividend strategy, and pension contributions assessed before 5th of April. The following January, no panic, no scrambling, no stress. The tax was already ring-fenced, the income hadn't changed, his system had. Why does this planning window matter? Right now, you have clarity. You know what you earned last year, what tax it generated, where it felt uncomfortable, and we have not yet reached 5th of April, which means you have time to influence this year's tax position. This is when we review your pension contributions, your dividend levels, salary you're taking from the company, your capital allowances, timing of your income and expenditure, and the use of your personal allowance. If you wait until 5th of April, you are being reactive. This window is strategic. Waiting until next January removes most of your options. Acting before 5th of April preserves flexibility and reduces tax legally. So, what is the bigger lesson? If January felt stressful, it usually comes down to one of 3 things. No quarterly tax forecasting, no physical separation of tax funds, and overdrawing profits without understanding the personal tax impact. The solution is structured financial discipline, where you move tax money monthly, you forecast quarterly, and review before 5th of April. Tax stops being frightening when it stops being a surprise. So what can you do about this? If the last deadline felt uncomfortable, don't repeat the cycle. If you want to plan properly before 5th of April, book a tax planning review meeting using the link below. It's a structured advisory session where we forecast your position, review how you're paying yourself, and agree clear next practical steps. If you're not sure whether this is right for you, you can book a short clarity call first and we'll guide you from there. Because when you manage your cash flow with intention, tax stops being a surprise and your business starts working for you. I'm Lena Oduo from G-Hawk Accounting, Smarter Accounting, Stronger Business. I look forward to speaking with you.